Getting to the highest level of financial freedom can feel like a long way for many people. After all, half of Americans say they live paycheck to paycheck. Every dollar you save and invest gives you more freedom and better options later in life. When building wealth, ask yourself not what you can afford to buy, but rather how many years of financial freedom you have gained. Rather than comparing yourself to your peers, it's better to study data and look at your situation in terms of levels. Each level will relate to a different stage in how much you cannot worry so much about money. However, you don't need to reach a higher level to be happy. Here are the 7 levels of financial freedom. Level 1. Clarity and dependence. Firstly, it's vital to understand your financial situation by looking at all your assets and liabilities. You can use these major asset categories to do this effectively. Also, you'll need to account for any liabilities from student loans, credit cards, etc. You need to be aware of where you're spending money and track essential and non-essential expenses. Additionally, you'll want clarity in your financial aims and objectives in a specific, measurable, and time-bound way. At this stage, you'll typically be in your teens or early 20s and be financially dependent on someone else. Many may have a negative net worth at this stage as they take on student loan debt. Level 2. Self-sufficiency and survival. The next stage is commonly referred to as either the self-sufficiency or survival phase. Here, you need to be able to rely on paying your expenses without help from parents or anyone else. Young adults often find it challenging to reach this level without living paycheck to paycheck or taking out loans. Most Americans are in this stage, and many get stuck here due to the high cost of living in their local area. It's crucial to monitor your expenses every month, or at least every quarter, to know where you are overspending. Level 3. Stability. At this stage, people have enough left to invest for retirement and building an emergency fund. You should be able to take on any unexpected expense while having enough money to cover at least 3 months. It's a good idea to create a safety net for yourself or your loved ones in the event of illness or other events that may negatively impact your wealth. At this stage, you probably have a retirement account and own a home, which lowers your financial stress considerably. Moving into level 3 does not mean having a higher income, but rather having more left over. 31% of Americans making more than $100,000 are living paycheck to paycheck. Simply because you're on a high income does not mean you'll be comfortable financially, as most people in America live through debt. Level 4. Security. At this stage, we've built up enough savings in an emergency fund to last at least 6 months. Additionally, we would have paid off any high-interest debt and do not have to worry much about losing a job. You should know approximately how much you need to spend at a minimum on all necessities to see how many months you can survive without any income. You will not be worried about paying your expenses, and you should have money left over to build an investment portfolio. Additionally, you should be able to comfortably afford to spend on a moderate amount of luxury items if you want to. If you're under 30, it's worth considering that you could face many variables later in life that can easily take you down a level. For example, you may have kids, which can easily add a significant amount to your monthly expenses. Beyond the age of 40 is when you really gain a stronger understanding of the trajectory of your expenses and can build a more reliable foundation of income. Level 5. Flexibility. At level 5, the amount saved must be at least 2 years' worth of living expenses. While it's good to save 2 years of expenses, it's better to save that money in a low-risk portfolio to beat inflation. A low-risk investment portfolio will almost certainly beat the savings account interest rate banks offer. As long as you have access to the money, then it does not matter if the 2 years of expenses saved are in savings or investments. If you put most of your money in a savings bank account, the interest gained will almost definitely be less than inflation and you'll be losing money. While considering an investment strategy, you should think about the overall risk, liquidity, time frame, and tax implications. If you're finding value from the video, hey, please click the like button because it helps. During this level, you could comfortably take a year off from work. Level 6. Financial independence. At this level, we transition from making more money from our time to making more from our money. All your expenses should be easily covered while having additional savings for your family's future expenses. Often, it requires a net worth of over 25 times your annual expenses to be comfortable at this stage. Anyone who achieves financial independence can live entirely from income made through investments. Typically, people will have their investment income from a stock investment portfolio or rental properties. Ultimately, getting to this level might mean being frugal to lower expenses so people can invest more. Nowadays, there are many resources to help save more, and most people understand the power of long-term compounding returns from investing. By this point, work becomes optional. However, most people still carry on working through this stage for additional income. Level 7. Abundant wealth. The critical difference between levels 6 and 7 is that you don't need to monitor your portfolio so much to generate enough income to cover your expenses. Also, you can easily afford to take on a luxurious lifestyle without any financial worry. Basically, at this level, you have enough money to never have to worry about it again unless something terrible happens. It doesn't necessarily mean you can afford a private jet. However, you'll have no worries about luxury spending. Your time will likely be spent more on your health and social life. Those with a large amount of wealth often use the 4% rule to help them plan for retirement. Simply put, the 4% rule means you only need to withdraw 4% of your portfolio to cover expenses while leaving enough left over to cover inflation. In theory, this will allow your portfolio to grow over time. However, we each have different levels of lifestyle expenses, and inflation rates fluctuate over time. Therefore, it's important to use the 4% use as a rough estimate rather than a magic number. Check out this video here if you want to learn more about retirement investing using Vanguard Life Strategy funds. At this stage, you'll consider inheritance plans and how much you'll leave behind for future generations. Also, you'll probably spend time looking into philanthropy and seeing how you can make a positive impact on good causes. You may have realized that the key to reaching higher levels is to invest consistently throughout your life. By investing, we create passive income that is not tied to how many hours we work. You cannot work a full-time job your whole life. Therefore, it's essential to consider other ways of making money. Additionally, inflation is taking away your savings year by year. In 10 years' time, more than a quarter of your savings will disappear if inflation stays at its current rate of around 3%. Ultimately, financial happiness is unique for each individual, as we each have our own financial desires. Many will be happy in level 2 or 3 while finding pleasure in the simpler things in life, while many are unhappy in level 7. Your pursuit of happiness and financial well-being largely depends on what you feel content with. Check out this video on how to achieve financial freedom. Also, please consider subscribing and clicking the like button because it helps. Cheers!